Hello, welcome to Dickson Realty's second quarter of 2026 Reno Sparks market update. It's been a really good quarter. It's been a healthy, I feel like, first half of the year here in 2026 for the real estate. Some good news. We know that Nevada continues to lead the nation in job growth. Nevada actually posted the fastest job growth rate in the US over the past year at 1.8%, and Reno's unemployment remains low at around 4.1%. So, job economic wise, things look really positive, and I think that is what's also helping the real estate market here. We do know that affordability is still a factor in regards to wages tracking with where prices are going. And that leads me to my first slide of where we're at with our median sales price in Reno Sparks. Surprised to see that we had another big increase month over month. So 2% for the month of June, which takes us to an all-time new high of 645, which is just 10,000 over that 635, which was yet a new high back in May. So the fact that we've had 5% growth just in 2 months and is the same growth and appreciation we've seen year over year says something that the market is actually really strong in the face of some headwinds, such as affordability. Rates can still be considered, as far as relative to prices, high. So that's interesting to see, but again, it is strength for the market. The next slide is our homes sold. This also shows a very healthy market. So we've had now in the month of June, in the last 3 years, the most homes sold. So you can see here 517, which is an increase of 11% month over month and 10% year over year. This actually used to be a fairly average number that we would see in 2015 to 2019. We would see actually in the summer months as many homes sold as 550 to 650. But our average used to be 500 across the board. That average for the last 3 years has been around 350. So again, that picking up is a good sign as well that the market is doing well. New contracts, kind of looking at the month ahead, what would be closing, and we're seeing that we're down just 0.2% month over month, but it is an increase of 15% year over year. So that means that July versus last year will probably be a really good close month as well. So probably not a fluke that June was as well as it was, and that the summer is probably going to continue to be pretty strong. The next slide, looking at new listings, we continue to be in this band since June of 2022 of about 600 to 200 homes coming on the market throughout the year. We're starting to come back down. We typically see the surplus of new listings from March, April, May, June, and then the summer months kind of steadies off and then falls back down to that 200-300 number over the course of winter. So this is kind of tracking with what's normal. My favorite slide, though, is always the active inventory, as I feel like this really represents our supply part of the equation. So we have increased the last 4 months around 8 to 10%. We increased in June 9%. That brings us to 896 homes available. Just remember that the average, again, back in the normal market, was around 1,200. So we're still about 300-400 homes shy of what would be average. So again, I think that's what's also propelling appreciation this year, is that we've had strong demand and lower than normal inventory. And really, when we started to see some weakness in the market last year was at this point where we had active inventory back up to 1,200, and our demand wasn't sustaining. And so that's very relative. It doesn't always Pricing isn't always just relative to demand, is what I'm trying to hint at. That inventory can really play a big factor of our prices. The next slide for days on market just to helps to get an idea of how quickly are things moving. And for the last 4 months, again, it was a strong market. We saw days on market declining, meaning that homes were closing sooner. And that did adjust in June, which is interesting because we know it's such a strong month. That days on market actually climbed about 15%. It is usual that once we kind of get through summer, go into fall and winter, that we see the days on market start to kind of climb back up to around that 80 to 100 days. But I expect for the rest of the summer that we'll probably be in this 60 to 70 days on market. which in the long scheme of things is actually a very healthy market. We used to see things closing on average throughout the year 90, 100, 120 days. So the market is still moving relatively fast versus what it has over the long period of time. And then the last slide I just want to share is interest rates to give you a snapshot of where we've been over the course of the last 12 months. And I think the important thing to note is we've seen the last 6 weeks start to lessen. And so we've been in a band in that 30-year mortgage rate between kind of 6 was the low point and around 6.75 was the high point. Of course, January, February of this year, those interest rates got down to that lowest point, and we really felt it on the real estate side as far as just a real frenzy. Every quarter of a point reduction in kind of the average mortgage rate does seem to really open up a brand new pool of buyers. So again, interesting that yes, we did have some decrease over the last 6 weeks in interest rates, but we're still having strong demand. If that rate were to get down to back to 6%, I think we'd have even more appreciation because we'd have even more demand. So mortgage rates have always played a factor, of course, in affordability and in the market, but I feel like it's such a sensitive thing that it's even more important now to watch. So we'll see what happens there. Thank you so much for watching. We hope that this is always informative and that you'll reach out to your favorite Dickson agent should you need help with anything. Thanks so much.